All right, Kyle, let's get into this. This episode is kind of like we're gonna do like a live analysis,
Mm.
a live kind of recommendation analysis for you listening right now. We've done a number of episodes on the Smith maneuver. We're talking about, using that to capitalize on, creating a situation where it allows you to essentially, take your mortgage interest and make it tax deductible. We've done a few episodes there, and we'll put those episodes in the show notes. So if you haven't gone back and listened to the Smith maneuver, the Smith maneuver is a great maneuver to create. To create wealth. Like we talk about wealth building here on this podcast as well, Canadian Wealth Secrets. And it is a secret. It's not really a secret, but it is a secret sauce move. And if you are, wanting to create more wealth, and you can be doing this by, say, creating kind of this capital that you may have, had access to, but you're creating a little bit more every time you kind of utilize it. So we'll let you go back and listen to the Smith maneuver, but this particular episode is we've had a person, a listener, so that listener might be listening right now. They reach out to us and
Mm.
say, "Hey, I've listened to those episodes. I'm super interested. I'm super eager to learn more." And they tossed us a scenario, and
Mhm.
this is what we get all the time, right, Kyle? Like we always get emails about scenarios. We talk with people on a regular basis every single day. Kyle, you are primarily on calls with clients, but also listeners of this podcast every single day, looking at scenarios, looking at their wealth, what their wealth plan currently is and where it could go. So we got an email from a listener, and we just today on this episode, we kind of wanted to like take those questions one at a time, because there was a number of questions in the email, and we'll just kind of break it apart here and kind of talk about this live analysis so that you can hear, and maybe this situation applies to you, but also be like, hey, maybe I can learn a little thing or two about the Smith maneuver and other tools along the way. All right, Kyle, hit us up with the email, and let's get into it.
All right, all right. So this email came in from Mandy. I'd had actually a couple of conversations with Mandy in the past. And one of the things that came up as they were along their wealth building journey, they had a home, they had a mortgage. Those who are watching right now can see the email up on the screen here. We blocked off all the details so that you can't identify who this person is. But one of the things that they were curious about is the idea of the Smith maneuver. And something that I think is worth mentioning here, and for everyone who's been listening, you've heard some of our previous episodes where we talk about the Smith maneuver. Keep in mind, it is an ongoing maneuver. Borrowing against your home with home equity is not necessarily the Smith maneuver. That's just borrowing
Right.
money
Yeah.
and then investing it in something one time. And that's something that is commonly sort of misunderstood in terms of the Smith maneuver. So let's read this out. It says, "Hi, Kyle. I enjoyed this podcast. This was in response to our follow up Smith maneuver episode. And it said, glad to hear you're testing this out for yourself. We've secured our mortgage renewal and have a $300,000 home line at variable rate, and it can be converted to a fix. So many of these types of sort of home equity sort of lines of credit that are attached to your traditional mortgage, those kind of work hand in hand, and they're kind of flexible, right? Like you have this fixed portion that
Mm-hmm.
you pay like a traditional mortgage, and it slowly opens up more and more credit to a home equity line of credit. Now, when you set this thing up, you can design it in a number of ways. So for some people, they go, listen, I owe 300,000 and I have 600,000 of equity in this home, and they say I don't want any line of credit off the bat. I just want to slowly open this line of credit up as I pay down the mortgage. You can do that, or you can say, listen, give me this portion, maybe 300,000 here, and then start my line of credit up to the maximum that you'll give me. Usually that's up to about 80% when you combine the traditional and the home equity line portion. So,
Mm-hmm.
what we don't know in this case is exactly what is going on in Mandy's scenario yet. She said, "Do I have to set up a special plan to take some of the 300,000 and use it to invest?" So, my gut here says that this is 300,000 of available home equity that
Right.
she could like take out today. Like she could go to
Yep.
the bank, say, hand me a bag of cash. Good luck. They'll never hand you a bag of $300,000 of cash. It's hard to get like $6,000 of cash these days without like ordering it ahead. However, you get the idea. She could take that and reinvest it. What we don't know here is what is left on the mortgage currently. So it sounds
Right.
like there's still a mortgage going on in the background here, but that's like a separate portion here. She's got 300 to invest. And she said, since we already have this defined equity built up, I assume it's not necessary to have the readvanceable mortgage, as I cannot see us using more than 100,000 for the strategy. So she's got 300,000 available,
Mm-hmm,
and
mm-hmm.
she only wants to use up to 100. So I think the answer to that question is, you're right. You don't need the readvanceable portion.
No.
Now, I mean, for me and you, Jon, I think the logic in my mind is that I want to continue to have as much available access to my equity as possible. So if right now you're handing me two options, that even if I don't have plans to use all
Yeah.
300,000, if every day I make a payment or every month I make a payment to my traditional mortgage, it's going to open up a larger and larger line of credit. In my opinion, it's better to take that option, right? Because I don't know about you, Jon, we've talked about it on the podcast before, but lenders are amazing at letting you borrow money when you
Right.
don't need it. And when you actually need it is when they're not as willing. So I would
Yeah.
say if they're going to give you that option, I'm certainly going to take it, even if it's not in my short or medium term plans.
I completely agree, because you never know. Like, you can treat it like we've talked about here, specifically about emergency funds. You could be using it as an emergency fund, and you never know when you might need to pull it out, or all of a sudden an opportunity comes along and you wish you had a little bit more than what you say were locked in at. I think the readvanceable mortgage is a smart move. Now, that first question, which said, do I need to set up a special plan to use the $300,000 to invest? And it'd be like, no. Like, you've got, like, that's the nice part about your equity. You've already done the pre-approval. You've already gone through all of that. They're saying, hey, we're securing this against the value of the home. That 300,000 is for you to withdraw, do whatever you want. Like you said, bag of money if you want. There is no special need there to get access to that. But I think the idea here is you, if you're only going to go 100K, then there is no reason for you to even think about the Smith maneuver, and it doesn't really
Mm.
apply here, because the Smith maneuver, is, and I think if I kind of go down to a bare bones kind of scenario here, and use their numbers or some numbers in a sense, be like, well, and you're right, Kyle, we don't really know exactly how much is here that is the mortgage portion and how much the equity portion is, but it sounds like they already have 100K of equity that they allowed to kind of utilize. Now, your Smith maneuver might be a good move if you're a person where I currently don't have any equity, and I'm know that I want to use that 100K now and more in the future. That's when you go, okay, I want to, like, continually, like you said, it's, I want that constant kind of change between the value of the mortgage, the traditional mortgage portion of my loan, and the home equity portion. I want to continually create that gap, or that value, so I can take that and do what I was going to do in investment. Like if you were a situation where you grabbed your mortgage, it's like you're fresh out of the gate, and you've got the value of the home. Maybe you did an 80% LTV on that home, which means like you borrowed 80% already of the home's value, and they're like, give me the home equity line of credit. And you look at it and you say, look, I've already got 80% borrowed. Therefore, my home equity line of credit portion of my loans, like the top value I would get for my home, is actually like $0, because
Mm.
you've maxed out your 80% between your mortgage and your home equity line of credit right off the bat, because you went 80% LTV. But then it's like, the Smith maneuver might be a great move for you if you're like, now I have no room to borrow money to
Mhm.
put into, say, this investment or this investment. So it's like, let's say I have my extra $1,000 a month that I wanted to go in this investment. Now it's like, let's put that on the mortgage. That will create the $1,000 on your home equity line of credit, because now it'll say it will go from $0 available to $1,000 available. And now
Right.
you go and put that in your investment, and now you're on your way to utilizing the actual Smith maneuver.
Right. Absolutely. So, kind of reiterating that, what it sounds like here is that Mandy's looking to borrow some equity that she already has available So she's not actually performing the Smith maneuver because she doesn't actually need, as she's sort of mentioned here, she doesn't need the readvanceable portion in order to accomplish her goal. One thing I want to address here is that, again, if I'm doing Smith maneuver, it's like I am paying down some of my mortgage with money I had intended to put into an investment in order to make some of my traditional mortgage payments, the interest on it, to make it tax deductible. So what we're doing is you're trying to swap it, right? So you're basically taking the balance of your mortgage and you're not actually changing what you owe on it. You're actually just converting some of it to tax deductible interest instead of paying it down. So that's really important to note here. So when you're borrowing against your equity that you currently have, you're not really performing a Smith maneuver at all. Your traditional balance is going to stay the same, and you're actually adding more debt to your debt load. So if you think about that, we don't know what the traditional portion is on her scenario, but let's say she owes 100,000 on her home, and then she has this $300,000 line and she borrows 100. She's now doubled the amount of debt she has. Half of it is tax deductible interest. The other half isn't, but you've actually doubled your debt load, which is very different than taking, $1,000 or 100,000, paying off the traditional portion and turning all 100,000 into tax deductible debt. So that's a really important piece here. Now, I want to address one last thing before we move on. And it's this idea of setting up a how did she word it here when I bring it back up on the screen here? It was something like, um, do we have to set up a special plan to take some of the 300,000 and use
Right.
it to invest? What I think that might mean, like what I think she's after here is like, do I need to like do anything special? Like you
Right.
don't have to like
No.
tell the bank. You don't have to do anything like that. But what you do have to do is you have to make sure that you're documenting what's going on. So that means when you make that transfer from the home equity line of credit, in my opinion, it's best to try to keep it as clean as possible. So if I'm going to send that to a title company in the US to buy property like we just did recently, it's great to go straight from the line to the title company instead of, say, having it go from the line to your personal checking account and then out from there. There's still a paper trail. You can still bookkeep that. You can still track that, but just trying to keep it as clean as possible is best for you. And that also means you're going to have to track the actual interest that you're paying, right? You could do this a number of different ways. You can get a statement at the end of the year that tells you how much interest you've been charged on that account, or you can actually just go through and calculate the interest only payments each and every month. However, the one thing that I think is important when we talk about setting up a special plan is that if I plan to borrow 100,000, and let's say there's a month down the road where I need to borrow for personal reasons. I need to borrow because the furnace went in the home
Right.
or something on the personal side. It makes it muddy if you're taking some money out personally. And now it's like I have some interest being charged on this investment, some interest is being charged on the money I'm borrowing personally. That personal money, that interest is not tax deductible. So you have to be cautious there. And what we would recommend is you call the bank and say, listen, if I only want 100,000 to invest like Mandy has here, you could say, hey, listen, Mr. or Mrs. Banker, can you split this up into two different accounts? I want $100,000 over here. This is line of credit account number one, just like credit or checking account number one. And then there's home equity line of credit account number two, and that's going to have the other 200,000, which might be a rainy day fund. Down the road, you might decide, hey, maybe I want to add another account. I can split it up even further. Most banks are pretty flexible like that. So if you know that you might use some for personal use, some for investing, having two separate accounts or more could make sense just so it's easier to track, nice and clean. And if you ever get audited down the road, that it's just an easier process to be able to say, here it is, here's the interest that was written off, and we're good to go.
For sure. For sure. I would also recommend that with the muddiness can be, it could be, a slug when the time comes. Now let's move on to one of our other questions here. It said another question: would it be best to do the 100K right away, versus staggering over years, since our timeline to pay off is less? So to me, what she's saying is like, okay, I have $100,000 to invest, and she hasn't mentioned like where that investment is, whether it's buying a property, whether we're putting it into, let's say, the stock market, or in index funds, or other capability, other equities. Um, so she's basically saying to me, Kyle, is like, should I like dump this in now, or should I like dollar cost average this over, a certain amount of time? So that's a toughie, because that's the crystal ball. If you had the crystal ball and said, hey, I'm at the very bottom of the market right now, dumping 100K in would be great. If I'm at the
Mhm.
very top of the market right now, then maybe dollar cost averaging is the way to go at this point. But there's like, are we at the bottom? Are we at a top? Are we on a bull
Totally.
run? Like you have to kind of know those things, and that's about timing the market versus, say, let's just get it in there, and time in the market is the better move. But like we've talked too about, if timing the market, or if time in the market was, and it is the bigger winner. But that first year, if you dump, a big chunk of money in, and it drops within that year, it's a long time to recoup, say, that initial amount. Like when you have a really down year in year one, the data shows that it takes forever to recoup that, and say get to those values, instead of saying like, hey, I'm in the middle, and we dollar cost average in at that point. So I don't think we can, be the decider in this, but
Yeah.
you got to kind of make that choice yourself.
Yeah, and to be honest, it's like again, kind of to your point, I reiterating it. It's like taking 100,000. If you just came up with the idea, my biggest wonder would be is like, what are you investing it in, and how comfortable and confident are you
Right.
to invest it in that thing? Now, based on the plan here, okay, now we're speaking at high level. Really what we probably should have did is got Mandy to join us on this episode so we can ask some of these things. But here's the sense I get, though. If your goal is to only invest 100,000, that's your goal, that's the limit that you're willing to do. By taking the 100 in, if tomorrow the market tanks, then you have to just hold on. There's no more dollar cost averaging there, right? So like
Right.
it to kind of like really rubber stamp that, it's like, okay, you got 100 in, and great if everything goes smoothly for the next few years, because it sounds like you have a 5-year time horizon for retirement. It says here, if we
Mm-hmm.
read a little
Mm-hmm.
further down
Mm-hmm.
the email, they talk about the idea that you only want to put 100 into this strategy maximum. So really what I would want to do, if I put 100 in today and then tomorrow the market tanks 20%, I want to be able to like put in like 200 more, like if that was me, right? So I would say maybe you want to put a small chunk to start and then DCA from there. Like you really have
Mm-hmm.
to think about the strategy, and yet just have to be confident in what it is that you're investing in. And after it says that you're hoping to be mortgage free in 5 years, now, does that mean that you also want to have no balance owing on this investment account? So you already have, I think, 100,000. No,
She
right
sounds like,
now they already have a $50,000 leveraged investment
yep.
already in
Yep.
some other asset, right? And I do have it in the notes. I can't remember what it was exactly, but so 50,000 is already in there. So 100,000 is the most that they want to, add to this plan. So my big piece here would be is like, are you okay? Like when you say you want to be mortgage free in 5 years, does that still include the 150,000 here that you're going to be paying interest on and getting the tax deduction on? Because remember, Smith maneuver in a perfect world, from a completely rational standpoint, the thought is you should keep the balance of your mortgage essentially forever, because you want to write off all that interest. So you have
Right.
all these, you have to pay taxes. So why don't we just write off all the interest? That's actually going to make sense, but emotionally it might not make sense.
Yeah,
So
it's
when I hear
tougher.
it's like, I want to be mortgage free, does that also include the 150? If so, then basically what you're saying is that I'm going to take this 100, I'm going to put it potentially all into something, say today, and I'm hoping in 5 years that I have at least more than the 100 to pay that off. I've been
Mm.
paying off my mortgage at the same time. And then we're kind of like, debt free at that point. the question then becomes is like, is it realistic that that's actually going to happen where you'll be completely able to pay off the debt, both on what you borrowed and what you borrowed for investment, as well as what you've borrowed against your home just along the way
Right.
with the traditional mortgage?
Well, I think this is where the Smith maneuver might make sense for them. If their goal is to be mortgage free and that's just a mindset thing, then maybe, and they're okay with borrowing for investment purposes, this is where you can make your investment tax deductible. Like it's going to be tax deductible in, say, the line of credit if it's earning income over in an investment, so maybe the goal is to pay down that mortgage as fast as possible with whatever funds you have, but go with the readvanceable mortgage so that you can then use the Smith maneuver to dump more money into your investment. So let's say in 5 years, officially, your mortgage is paid off, but you've got this debt, attached to your home that
Right.
is really your mortgage, but mindset wise, it's your investment, and you're making money off your investments, which maybe that's what she's thinking about. She's thinking like, I want to be mortgage free, but she's not going to be mortgage free unless she takes that 50K out of there and
Right.
and it's against the home, right? Because that's the reality of like what you've done. You've transferred the debt from one account to another, but the Smith maneuver makes a lot of sense here. If you're like, I want to invest, I can then use that investment for tax purposes and income purposes, and officially, I have no mortgage.
Right. Well, let me put it this way. Here's like, I think what I'm going to do is reiterate what you're saying in a slightly different way. Is like, if I have a 5-year time horizon right now, and again, we're making assumptions. Maybe it is the plan is to keep this debt, ongoing. But like that 5-year time horizon, it suggests that, and if I considered, even if it's a thought that I'm going to take 100,000, get it into an investment right away, be it real estate, be it the market, whatever it is that they're deciding to do, if that's what they want to do, they put that 100 in. What that tells me is that you believe that the investment that you're making over these 5 years is going to outperform, meaning you're going to like have an arbitrage, a positive arbitrage in
Mm-hmm.
terms of what you're going to earn
Yep.
versus what you're going to pay in interest on that borrowed amount. Now, we're not lumping in the traditional mortgage. That has nothing to do with this investment. So the thought is, the logic would suggest that if that's true, that actually I probably shouldn't have necessarily $100,000 limit, right? Just logically, emotionally, sure, you have a limit here. But if you believe that this is going to be true over the next 5 years, then it would make sense to keep that investment for the long term and
Yep.
keep the debt for the long term, right? Because this investment is going to continue to compound and grow, which over time is going to produce more income, which produces more taxable income, which produces an opportunity for us to write off this interest. And ultimately, in my world, even if $100,000 is the goal, Jon, I'm going to give my sort of secret sauce here, what I think based on what we know and some of the assumptions we've made. And then I want to hear your thoughts.
Mm.
What I think, instead of doing, as you mentioned, you've got a lot of equity there. Your goal is 100,000. I would say going smaller and going harder on the traditional mortgage with money, putting money harder onto that mortgage so that you're opening up more line of credit room, assuming there's a readvanceable mortgage. And at the very same time, you're doing legit Smith maneuver. You're taking that same amount of money and you're putting it into the market. And that would allow you to DCA. It will help you
Mm.
slowly scale into the market, right? So we're not going to do this all at once. And because guess what? If that market tanks in a month and you're DCAing in, you're going to be like, this is the best. Because now you might go, now's the time I want to put down a big chunk. I want to put down 30K right now, or I want to put down whatever that amount is that you want to put down at that time. But right now, I would say just slow and steady is going to win the race. I also get the sense that, based on, I've had conversations with Mandy, Jon. I know we've chatted about these calls, but you weren't on the calls. I get the sense based on the paying down the mortgage, wanting to get rid of debt, that sort of thing, that there's a conservativeness here too,
Mm-hmm.
which
Mm-hmm.
DCAing is just going to be more conservative. And honestly, I think in the long run, it is almost always going to be better off because it's so hard to predict what's going to happen next in the markets, right?
I totally agree, and I totally agree with your plan here to continually, get that mortgage paid down, but then dollar cost average into the market, using that Smith maneuver, because you are assuming that this deal, this investment is a winner, is a better play than say, just leaving it in something else. So I love that, and I think that's a great move for Mandy.
I think so too. Hey, friends, listen, if you found some value in this episode or any other value in any other episodes, please leave us a rating and review on Apple Podcasts. It's a huge, huge help for us. And remember, if you want to hop on a call, chat about your next moves, we specialize in helping incorporated business owners free up the retained earnings that are trapped inside your corporate structure so that you're paying less personal taxes over the long term. Reach out to us at canadianwealthsecrets.com/discovery. And hey, if you're looking for some personal assistance along the way, you can also reach out at the same spot, canadianwealthsecrets.com/discovery. And we look forward to hanging out with you soon.
All right, Canadian Wealth Secret Seekers. We'll see you next time.
Just a reminder, my friends, this content is for informational and educational purposes only. You should not construe any such information or material as legal, tax, investment, financial, or other advice.
John is a mortgage agent with Bricks Mortgage, license number M230068003. Kyle Pierce is a licensed life and accident and sickness insurance agent and VP of Corporate Wealth Management with the Pan Corp team. That includes corporate advisors and Pan Financial.